Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's February the 12th, 2017. Well, this week we want to cover off 4 more companies in terms of the latest earnings coming out of some of our major holdings. And as we mentioned last week when we started this series of videos, the whole purpose is just to keep investors up to speed with what's happening in some of our companies, and also just to familiarize yourself with the different businesses that are probably in your portfolios. Now, everyone has a slightly different portfolio. We customize our portfolios, but we're trying to cover off really the major holdings, sort of the top 25 amongst our group. So this week we're going to cover off 4 more companies that released earnings last week, and that'll be Agrium, Input Capital, Suncor, and Church & Dwight. So first in line would be Agrium, and there's a slide that's going to go up on the screen there, and you can just take a quick look at that. Agrium is a leading agricultural company. It's a global business based out of Calgary, Alberta, and there's really 2 divisions to the business. Retail, so it distributes crop nutrition, seeds, crop protection products, provides financing and other services directly to farmers or growers. And then there's a whole division called the wholesale division, which produces and markets and distributes crop fertilizers. And the main fertilizers there would be nitrogen, potash, phosphate, and so forth. Now, the company, from a stock price perspective, has done exceptionally well because people are anticipating the next year or so being quite favorable for the ag sector. The last couple of years have been a little bit more difficult for the ag sector, and you can see this reflected in their numbers. The revenue is down about 7%. Adjusted earnings per share were off about 39%, which is, sounds like a big number, but they're still very profitable at over $4 a share. And they've maintained a very healthy dividend at about $3.50. Now, what's more important from our perspective is the long-term positioning of the company and the strategic nature of their assets. This recent downturn in the ag sector, in terms of the ones that, fertilizers and crops, seeds and so on, has provided an opportunity for Agrium to actually buy Potash Corp. So you'll see that on the slide there under new developments. They actually have been able to merge with Potash Corp. Now, Potash Corp is one of the most important long-term assets in terms of reserves of potash. So this has been a wonderful time, and it's an example of a great company that can take advantage of a tougher market condition to actually expand its business and become even a larger leader in terms of their market segment. So that's Agrium. We maintain positions in this company, and whenever there's any kind of weakness, we buy more. The second company is Input Capital. And Input Capital is a 4-year-old company, and it's a financier to farmers. It provides cash for working capital, the day-to-day operations of a farm. And in return, they don't just get charge interest, they actually get a payment in product. And in this case, their focus is on canola farmers. So what they get in return is bushels of canola, which then they sell in the market. And we really like this model. It's very similar to the streamers and the royalty companies in silver and gold, but now this is in the agricultural space. So on the slide that's going up on the screen here, you can see that the company's been expanding very, very quickly. In fact, we think the stock is quite inexpensive, which is really providing a wonderful opportunity to accumulate. But if you can look at their active streams, they're up about 50%. 57% to be exact last year. So they have 121 relationships now, or contracts. They invested over $12 million just in this last quarter in upfront payments. So that'll give them in return lots of canola that they can sell into the marketplace. Their earnings per share are running about a cent. The quarter by quarter is going to vary depending on how much they sell. This is a business you really have to look at over a full 12 months because the quarter-to-quarter results are very, very much variable because of the seasonality of the farmer. And they've just initiated a dividend of 4 cents per year, so that's over 2%. And we expect the cash flow on this company just to really, really ratchet up over the next few years. And so we really like this company. And so it continues to do very well in the market, relatively small, but no debt, lots of cash, and more importantly, lots of cash flow coming off of the sale of canola. So that's Input Capital. The third company is one that, I think everybody's very familiar with, and that's Suncor. And they're really one of Canada's largest and most important oil and gas companies. And we maintain not a huge position in the oil and gas sector. We're somewhat agnostic to where the price of oil and gas is going to go. So we want to make sure we own the companies that can be profitable at lower prices. And so Suncor just released their earnings. And up in the slide, you can see just a quick highlights of that. Their revenue decreased about 9%, and that's strictly as a result of, these are the 2016 results. These are the annual results. And that's simply because the price of oil has been down, as most people know, over the duration of 2016, although it's come up a little bit near the end. What's more important is their earnings per share. They've been really, really efficient in how they run their business, and their earnings per share are up over 120%, and their dividend was increased by 10%, up to about 32 cents a quarter, which is over $1.28 per year, and that's well over 3% dividend yield on Suncor, which is great. And most importantly, this is a company with long-term reserves. In the downturn about a year ago, they were able to buy Canadian oil sands, so that makes them the largest player in the whole Syncrude project in the oil sands. So this is a company that is incredibly profitable even at these prices. And it's interesting, the company's talking about taking their cost in the oil sands down to around $30 a barrel in the next 3 to 4 years, which would be phenomenal, and their costs continue to decrease as they become more efficient. So this is, again, an example of an oil and gas company that we like to own. And as most people know, it's got the upstream, so it's got the development of the oil sands, it's got the midstream refining assets, and it's also got the downstream, which is their marketing operations and their whole retail distribution arm. So this is a integrated oil and gas company. We continue to like it, and whenever it gets close to $40 a share, we tend to add a little bit more, and most of our clients have that in their portfolio. Okay, the last company that I'm just going to mention very quickly is Church & Dwight, and that's a consumer staples company. It's a U.S.-based company. It's also global. It's got most of its sales, though, are in North America. Now, Church & Dwight is probably best known for Arm & Hammer. That would be one of their key brands. And Church & Dwight's sort of a mini Procter & Gamble. And so it's a much smaller company, but it's got leading market share wherever it goes into different segments, like the Arm & Hammer segment. It's also in different areas in terms of pregnancy detection, and different areas that now in the gummy vitamins area and so forth. And so it's really a wonderful way to play consumer spending in staples, or the areas that they have to, people just continue to sort of have to buy. It's not discretionary. They're very basic products. So the slide that's going up on the screen right now will just give you a quick summary of their progress. They have done exceptionally well. The stock has also done very well. But their revenue was up about 3% last year, 2016. Their earnings per share over 13%. And remember, when the revenue is up 3%, this is a company that sells outside of the U.S. And so with the U.S. dollar being quite strong last year, that would hold back their revenue growth, especially when you're measuring it in U.S. dollars. So 3% is actually a pretty decent number. And most importantly, their earnings were up over 13%. They've increased their dividends by 7%. So it's about 76 cents a share now. Annual, and they continue to make acquisitions, sort of tuck-in acquisitions, where they can be a strong leader in different consumer product and health and beauty areas. And so this is a company, again, whenever they make an acquisition, their acquisition criteria is it's got to be a top number 1 or 2 brand in its class. There's got to be high growth, decent margins, and not overly capital intensive. And so this is a company that, again, is a wonderful way to play consumer staples, a heavy bias on North America, but increasingly looking around the world in various product categories. So Church and Dwight. So there's 4 more companies to give you just a quick overview and update on. And we'll look forward to updating you next week on some of our other top holdings that will be releasing earnings in the next little while, hopefully over this week. Okay, so if there's any questions at all, or you need to contact us, again, feel free to contact us, phone us, email, stop by the office. Thank you very much. Bye now.